there are a lot of parabolas out there, stocks that are just going parabolically higher. Some of them deserve it. Some of them seem a little bit like they're punching above their weight class.
He's not chasing momentum. Jimmy Lebenthal joins us to talk about the power of getting rich slowly.
Being patient is a virtue. They sometimes think I'm being stubborn.
He oversees $180 billion in assets. You've seen him on CNBC, and he tells us how to buy unloved stocks. I just want somebody to pay attention to healthcare.
Me too.
Is it a value trap? In those trough years, what made you hold on? Are you putting dollars to work in software?
I don't think I've ever really sold a share in Cisco. Any money manager listening to that is going to be like, wanting to stage an intervention with me.
I might have to title this episode a love letter to Cisco. When you choose a Raymond James advisor, you're getting more than independent financial management. You're getting access to complete financial guidance under one roof. From tax and estate planning to trust services for generational wealth and strategies for life's key milestones like buying a home, funding your children's education, or preparing for retirement, they bring it together in one financial plan. What also makes Raymond James advisors unique is their complete independence. With no proprietary product to promote, you will benefit from personalized services, all backed by the strength and resources of Raymond James, a powerhouse with $100 billion in assets and over 520 advisors nationwide. Discover how Raymond James can help you live a life well planned. Visit raymondjames.ca. The content provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult with a qualified financial advisor or professional before making any investment decisions. On this episode, we discuss JP Morgan, which is a stock that I own. Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. I'm super excited about this episode. We've got Jimmy Lebenthal joining us of Cerity Partners. He oversees a firm with $185 billion in assets, but you probably know him best from CNBC. And what's so interesting is that you think about CNBC, I think he's on the halftime report, but they've also got shows called Fast Money. And he's very much the opposite of that. I joked with him, he's almost like a Canadian. He's value-minded, patient. He will deal with years of underperformance if he thinks the thesis is intact and he's getting paid to wait. I could have also called this episode like a love letter to Cisco because a lot of these lessons are in his 11-year investment of Cisco. He's recently authored a book called How to Ride the Subway, Getting Around on Wall Street and in Life, which kind of weaves in his early life as well as kind of his general approach to investing. I'm a CNBC fan, so it was really exciting to get to talk to him. You can tell why they put him on 3 times a week because he really knows his stuff. He gives us 3 ideas as always. I think we're calling them, how to get rich slowly stocks. They're definitely maybe not your most obvious ones. And remember, if you want to get these pro picks right to your inbox, all you have to do is subscribe. Go to our website, inthemoneypod.com, smash that subscribe button. Okay, let's get into it. Jimmy Lebenthal, thank you so much for joining me on the show.
It's great to be here with you, Amber. Thank you very much for inviting me.
Obviously, you've got a pretty big day job as the chief equity strategist at Cerity Partners, which sits on like $185 billion in assets under management. Most people will recognize you, and that's how I'm familiar with your work. You're on CNBC. How many times are you on CNBC per week?
About three times a week, and I've been doing it for 13 years. I don't know how it got started. I kind of remember it getting started, but I didn't think at the time it would last this long. It's been marvelous.
I mean, we're big fans of CNBC. I've got 2 ex-CNBCers on the In the Money team, so we love it. I mean, what do you love about going on and communicating about the markets?
Well, for one thing, I'm allowed to be me. So prior to joining the Halftime Report, which is the main show that I'm on, I always looked at CNBC as a sort of fast money trading, in and out sort of environment. I'm very much a long-term fundamental investor. I think actually that's why they wanted me to join in a more permanent sense. And they let me be me. Sometimes, the more short-oriented traders may take a shot or two at me for hanging on to something, which I think being patient is a virtue. They sometimes think I'm being stubborn. Nonetheless, I am allowed to be who I am as a person and an investor. And I really like that. I really like also being able to communicate to people.
And, it's so funny because I just read your book over the weekend, How to Ride the Subway, Getting Around on Wall Street and in Life. And I kind of thought, I'm like, this is not a fast money guy. This is like, dare I say, you could be a Canadian, an honorary Canadian, value-minded, patient, growth at a reasonable price. Did I capture kind of who you are as an investor?
You captured it very well. And in fact, on the last part, I really appreciate your using growth at a reasonable price. In a prior millennium, I might have been labeled a value investor. But over the last 25 years, one has learned that, you have to have a little bit of growth in your portfolio. Again, at a reasonable price. That is how I invest. But if you're just a value investor, just looking for cheap stocks, you're going to have a miserable experience.
And I think that's good perspective. And you kind of tell this story through Cisco in your book. First, I'd love to know, before we get to the Cisco example, because it captures a lot of things, you taking ribbings from your CNBC colleagues, but what prompted you? Because you're already communicating with so many people. You've got enough on your plate. What prompted you to write the book?
I think it was a spur-of-the-moment idea, but once it got lodged into my head, it seemed to me a good venue to take what I'm doing on CNBC and expand it. And this was important to me because for anyone who has watched the show, it's very fast-paced, notwithstanding my long-term orientation. It's very fast-paced, it's rat-a-tat-tat, we're going back and forth. And quite often, I feel like I don't have the ability to speak on a topic or an idea longer than, say, 30 seconds. So with this book, it gave me an opportunity to take ideas that really deserve a longer treatment and really expound on it. And frankly, Amber, it's not just in the investments themselves, but in terms of what those human principles are that back the long-term theses that I put together in my stocks. So it's both the investing and the sort of mental mindset, the personality, if you will, that goes into making an investment.
Yeah, it allows you to kind of be a little bit more true to yourself as an investor. And I said I wanted to use the Cisco example because I imagine you're on 3 times a week for years. Like that's a lot of ribbing to take on. Yeah, I still like Cisco. And of course, in the long run, that proves to be fabulous. Cisco sitting at a record high. But talk to me, and I think it's a good example of like what brought you to the story, what made you hold on, even though it was tough, and where we are today.
Sure. And I really do like talking about Cisco because it does epitomize what I'm talking about here. I actually first bought Cisco in May of 2015, 11 years ago. I mean, it's incredible to think of. And at the time, certainly we all remembered Cisco from the late 1990s. It was one of the darlings of that era. In some ways, it exemplified the downfall of that era as well as its magnificence. By 2015, the stock and the company really had been left far behind by all sorts of up-and-coming technologies, whether it was social media or various software companies. I mean, we all know that it got very much surpassed. But when I looked at it in 2015, what I saw was a company that was vital to the architecture backing the digital world through its switchers and routers, very inexpensive at below 15 times earnings, with a marvelous 3% dividend yield. I also saw a business strategy that they were executing on to be more than just switchers and routers, more than that hardware that I spoke about. They were rapidly building out their software expertise, which, as I mentioned just a second ago, software companies had far outstripped the returns of Cisco. And software had the ability to have recurring revenue through subscription-based customers, as well as much higher margins than the hardware. And by putting the hardware together with the software, Cisco became a double threat. So all of those things together made me want to own it. It also had this wonderful attribute that in addition to the dividend, it returned capital to shareholders like me through share buybacks, all of which endeared me to the stock. Now, Amber, that's 11 years ago. A lot has gone on with Cisco since then. I'll pause before I continue if you want to ask more questions, or I can continue on with the narrative of Cisco.
Well, I also think 2015 is an interesting year to start buying because they also had a CEO change, right? From John Chambers to Chuck Robbins. And I wonder if that was a catalyst moment for you, a reason to take a fresh look at the stock. But no, please then do go on with how the thesis has played out now that it's firmly in the AI, flywheel.
Yeah. And you're right. A CEO change like that from a legend like John Chambers is actually often a reason that a stock gets lowered in price, giving the opportunity to invest. Now, as I continue on with the narrative, I want to just actually fast forward to where we are now from a share price return, because measured over the last 11 years, Cisco Systems has given a total return that is 3.5 percentage points greater than the S&P 500 overall. And it's done that with a beta, or an exposure to the overall volatility in the markets, of about 0.85. Amber, for an investor, that's the holy grail in many ways. For one thing, 11 years of an investment means that you haven't had to pay taxes along the way. Now, certainly if you are investing in an IRA, that's not applicable, but many of my clients are in taxable accounts. And so the ability to compound returns without paying taxes along the way in the form of capital gains has been tremendous. But even more so, to beat the S&P 500 with lower volatility, that is marvelous. And I often think to myself, my clients could go out and just buy ETFs. They could be passive investors buying S&P 500 depository receipts. But no, they trust me to pick stocks like Cisco that will do better. Not all of them do, so maybe I'm cherry picking, but Cisco has, as I said, nicely outperformed the S&P 500 during the time frame. And in that 11 years, Amber, a lot has happened. So I did mention the software and the hardware combination. They further took that double barrel and turned it into a triple threat by purchasing the security software company Splunk a few years ago, which really increased their security business. And it made them a triple threat when they went out to customers, because they could do all three of these things, security, software, and hardware, in one company. And that was definitely a selling point. However, coming out of the pandemic, Cisco ran into a problem. They had supply chain issues just like everybody else. And because of their supply chain issues, they were not able to meet all of the demand from their customers. What their customers did, and this happened in many industries, not just to Cisco, their customers over-ordered. So when Cisco worked out the kinks in their supply chain and was able to meet these orders, the customers found themselves with more than they needed. Their inventories were high. That created this so-called bullwhip effect in which they decreased orders, and the market did not like that. They did not like that Cisco's growth projections coming out of 2022 were less than expected, and they really put the stock in the penalty box. So that beautiful outperformance that had occurred through 2022 versus the S&P, it became underperformance in 23 and 24. But, and I'm almost done with the soliloquy, midway through 2024, the bugs were worked out in the supply chain. The triple threat was working well, and they were starting to get artificial intelligence orders. The numbers on the quarterly earnings reports came in much better than expected. So did the earnings guidance. The stocks started to take off, and it's really gained steam this year.
Now, but did you know, like in those trough years, what made you hold on?
A lot of things. One was the continued return of capital to shareholders. I believed in management first and foremost. I believed in the business strategy, that triple threat that I spoke about. I thought that the supply chain was going to be something temporary. It did last longer than I expected, which gets me a moment to preach the virtues of patience in investing. But there was nothing fundamental to the business that made me think they had lost their way. And when I think about that return of capital to shareholders, That's actually a beautiful thing when a stock price stumbles because they're buying back more share and rapidly shrinking the share count at these lower prices. So for all of these reasons, I stuck with it. It's turned out to be very good. There's one other aspect of this that I want to point out with regards to the balance sheet. They did have to take out debt to make the purchase of Splunk.
Mhm.
And over the last couple of years, as this capital has increased from the orders that they've gotten, not just from Splunk, but from artificial intelligence, they've been able to start paying down that debt as well as buying back shares.
Now, you bought it at 15 times. It trades at almost 30. It's at a record high. And the question is, does Jimmy Lebenthal, Mr. Value Investor, would you put fresh dollars to it today?
I am putting fresh dollars to it today. Now, I have to admit, I don't think I've ever really sold a share in Cisco. So for clients who have been with me for 11 years, this is a very big position, much bigger than the benchmark. It's about 7%,
Wow.
which any money manager listening to that is going to be like, wanting to stage an intervention with me. I may trim that, but I do still want to put new money to work. And the reason why, a few reasons here, I know the 30 multiple, I'm pretty sure that's a trailing multiple. On a forward multiple, we're around 26 times. And that's not, the 15 times that it was, but it is justified by the growth rate in earnings, in particular in artificial intelligence orders, which 2 years ago were running at a $1 billion a year run rate. Now they're running at a $9 billion a year run rate, with room for that to grow even more. They've actually garnered more control of their supply chain. So I think there is a lot of room for the earnings to come in better than expectations. And maybe that 26 multiple is actually a little bit lower.
And that's good, yeah, because there's two ways for PE to rectify, right? The price can come down, but the earnings can also go up. So obviously a favorite way to play AI. You said something about how Cisco exemplified the downfall of the previous bubble. Arguably, we're in another one. And I'm sure one of the top questions you get is, when is the party over?
It's a great question. I'm going to make a mistake answering you right off the bat and compare it to the late 90s. And the reason it's a mistake is because history doesn't repeat itself, but it does rhyme. I'm sure you've heard that phrase many times. So it's not going to be identical to the late 90s, but using that as an analogy, I think it's more likely that we're in 1997 than 1999. Now, let me try to back that up a little bit. When I think of the late 1990s, what I think about in terms of excess were the fiber optic networks that were being laid in all metropolitan areas around the world. And by the time we got to the year 2000, it turned out that over 90% of that fiber optic was dark, not being used, meaning that the companies that were laying it in the ground were doing it completely speculatively. They didn't have customers lined up. When I think about artificial intelligence now and the build out of these data centers and the demand for chips, what I hear from the major hyperscaling companies, the Microsofts of the world, the Alphabets of the world, what I hear from major technology investors is that every increment of compute that is brought online in the form of these data centers, in the form of more chips from NVIDIA, is profitable right now. The companies are being very consistent in saying that their growth rate would be higher if they had more supply of compute. That's a very big difference from the fiber optic network situation of 2000. I also look at the spending plans from the major hyperscalers, the Microsofts, Amazons, Metas of the world, and it just shows no signs of abating, primarily because of the profitability that I spoke of. So this party will end at some point in time, Amber, and I think that's unquestionable. I don't think that it's in danger of ending in the next year or so.
And there have been casualties, right? It's been fabulous for the overall market. It's lifted the overall market. Because these AI stocks have done so much better than, when you neutralize for the impact of them, the equal weight version of the S&P has been struggling relative to the market cap version, but there's been casualties and software is one of them. This week, though, maybe that's starting to change. And in fact, software stocks that kind of bottomed in April. They're up 26% since then. And Jensen Huang, the CEO of NVIDIA, said, this is an incredible time to be a software company. And that's the big question. Is Claude, is ChatGPT going to disrupt what Salesforce can do? How do you answer that question? And are you putting dollars to work in software?
So to answer your last question first, yes, we are. Including, Microsoft, which I feel is one of the safest software companies around. And obviously, it also has the Azure business, which is a hyperscaling business to perhaps offset the software business. But we're also putting money to work in a company like Adobe, which is right in the crosshairs.
Oh my goodness, that's right in the crosshairs. What's your thesis?
Yeah, the thesis is that the market has gotten carried away on the downside. Also true for Salesforce, also true for ServiceNow. Amber, you pointed out that right now as we speak, there is today and has been for a few weeks a little bit of a bid to the software sector. I think it's too early to call the all clear signal, but I do think it is people recognizing that as fabulous as these Anthropics and OpenAIs of the world are, side note, I think Claude is amazing. But it is not likely for anyone running a company, either as a CEO or a chief technology officer, to simply say right now that they're going to rip out all of their software platforms that have been tried and true for so many years to go with Claude, as amazing as it is, which still has some operational testing to do. We're also starting to hear, and I'm sure you've picked up on this, Amber, we're just starting to hear the comments that, hey, you know what? AI is expensive. Up until, have you heard this? Because
Yes,
I'm starting to hear
they're
this.
just letting people, everyone's token maxing, saying, go out, use it as much. And then they end up with these huge bills and they're like, whoa, wait, what did we get out of that? That's too expensive. Stop token maxing.
You just exactly described it, that we're right at the moment where CFOs and CEOs are saying, okay, hold on a second. All right, we did want you guys to start embracing AI, but now we got to put, some guide rails on this. So the idea that we're just going to let somebody, in the tech office vibe code a new software for imaging or document creation, maybe not. Now, maybe yes, but maybe not. And I think here's where the market is adjusting, is the market was really saying companies like Adobe and Salesforce are going out of business. I mean, they were pricing it that way, in my opinion, with Adobe selling at 10 times earnings. Now the market is saying, well, maybe we overreacted on the downside. And I do see more gains ahead for Adobe. One more thing, and it's a consistent theme with me. Adobe is buying back shares, and it's buying back its shares at 10 times earnings. You heard me just say that. It has basically no debt on the balance sheet. And unlike a lot of technology companies, when they buy back shares, they're merely sopping up the options that they're issuing to employees. Adobe is really, really rapidly shrinking the share count. So if Adobe continues to grow at low teens top line year over year growth that it's been doing for a little while now, those share buybacks are really going to propel the net income higher. Or it's going to propel not only the net income higher, but also the earnings per share higher.
But, a lot of people do come on and they say, yeah, these big companies are not just going to rip out their software systems. And maybe they're not. But I think about the companies behind these companies, how they're going to start. They're not going to be encumbered by the legacy systems, right? They're not going to have that tangled web of software. And, I'm a micro business over here with my own pot, but we use AI for so much, and I would have to pay so much more. And I just don't, because I'm starting with these AI tools. So isn't that more of a long-term overhang?
I think it is. So I don't want to appear to be overly ebullient on this. I think there's an opportunity here in these software stocks, but opportunity always comes with risk. The two go hand in hand. And the risk is that some of these companies do get disintermediated. That's unquestionable. And I've seen some applications that I've used with Claude that are quite breathtaking. That said, I do think the market has probably overreacted. By the way, Amber, and I'm sure you've talked about this before, there have been knock-on effects from this with regards to things like private credit companies getting clobbered on their software exposure. And to me, this does tie into what was going on in February when various research articles, I'm going to do air quotes on research, or various research articles were coming out predicting that 2 years from now, the only profitable companies in the world would be artificial intelligence and unemployment would be above 10%. That was peak pessimism. there's an opportunity here, but there is risk. And what you just said absolutely encapsulates the risk. It is not a slam dunk.
It sounds like, though, that multiples are enough, that it's cheap enough, and there is growth there that you're willing to step in at these levels.
I'm willing to put it in as part of a portfolio, which is to say a portfolio always has room, in my opinion, for story stocks like this. Maybe something's gotten unloved like Adobe. Now, a portfolio has to have a solid foundation of the core companies in the global economy. So, of course, I have exposure to Google, to JP Morgan, to Apple. But those are foundational. Where I really build the growth is these story stocks.
Okay, I love that because there's so many unloved areas of the market right now. AI is back to sucking up oxygen. So we talked about you finding, a date in software for some of these beaten up names, but other sectors, like take housing, for example. I mean, this week, Berkshire Hathaway buys a home builder, right? It's a really small one. It's the first deal for the new CEO, and it's tiny, fine, under $10 billion deal, but it's home builders. When have we been excited about home builders? The U.S. housing market sucks.
It really does. I'll go with you on that. This is a real value investment. And as you pointed out, it is tiny. I think it's an $8 billion versus $400 billion cash stash. The first move for Greg Abel, I kind of like, by the way, that he's not getting splashy. He's just doing something small. That's the way I want him to start up.
Is there a towel in there? Is there something to be seen in housing?
I can't get behind it. Not yet. I want to, Amber. I want to. A guy who has value in his blood, I want to get there. I can't see mortgage rates really coming down, and there's two reasons for that. Number one, I don't see the 10-year Treasury coming down, not meaningfully. And some of that is the negatives of inflation and debt deficit financing it. But some of it is also just good economic growth. So you start with that the benchmark yield, I just don't see coming down much. And then you add to it that mortgage spreads, they were kept somewhat artificially low by the Federal Reserve's buying of mortgage-backed securities, which has come to an end. So, 30-year mortgage rates in the mid-6s to almost 7 has been a tough environment for the housing market to get its feet under it. And I just don't see that changing anytime soon. I'd like to be wrong, by the way.
Do you think people will just eventually get used to it? Like just understand 6-7%, that's the new normal. We got to kind of adjust, get on with our lives, or we're not there yet?
I guess that has to happen, but I'm surprised it hasn't happened so far, because we've been at this for a few years now. And so it makes me wonder if it will. Now, this begs a question, by the way. What will all the millennials and Gen Zers and Gen Alphas, what will they do for housing? Ultimately, I think what we're going to see here is a major transition from housing stock that is owned by the baby boomers being bequeathed and inherited by those generations that I just spoke of. But it's really hard to see the housing market at large picking up with interest rates where they are. Again, I hope I'm wrong. It would be great for the economy.
Another unloved sector, I'm on about this, our viewers know, I just want somebody to pay attention to healthcare.
Me too.
Like, is it a value trap?
Well, it has been. Mm-hmm. It has been for a little while now, but it hasn't been a value trap for that long. And it does feel like just a few years ago, things were doing quite well in healthcare. Now, we do have to break healthcare into its constituent subsectors, right? So the insurance portion, managed care, has been really, really tough. And the reason for that is well known. The government has just squeezed down on the amount of reimbursements going out for Medicare and Medicaid. So companies like United Healthcare, like CVS, that built a meaningful business in providing those services, have seen their profitability in those areas go down. I do think it's quite possible that they have found bottom in those insurance areas. I'm not quite ready yet to dip a toe back into CVS and United Healthcare. I'm willing to be a little bit late to that. Other areas, though, that I'm actively looking at are the medical device manufacturers, which really have fallen on hard times, and I find it a little perplexing.
What's your favorite?
This is an area. What's that?
What's your favorite?
Probably Stryker right now. I mean, Zimmer Biomet, we got to take a look at as well. But before we pick stocks, we just have to acknowledge we've got an aging population around the world that's going to need more knees, more artificial hips. It should work to these companies' benefits. It hasn't so far. So I'm looking there. Where I'm mainly exposed in terms of healthcare is pharmaceuticals and biopharmaceuticals.
And you brought one of those as a top idea. So we're not going to share what it is because they got to stay tuned to the end of the show. So I'd love to get your thoughts on it, but let's wait until the end of the show when you reveal the name that you like in pharma. We have so many questions in the mailbag, but I keep peppering you with questions. I want to ask before we go into the mailbag. There's a lot that's hot right now. We talked about AI, but you've got like the SpaceX IPO coming. You look at semiconductors, and in your book, you really talk about being okay with FOMO, right? That fear of missing out. A lot of people talk to you about Bitcoin and just being okay. NVIDIA, you really sat to your discipline and only bought it. What was it? A couple of years ago, right?
2023, exactly.
2023, yeah. So now here we are frothing at the mouth for the SpaceX IPO and maybe even semiconductors. And what does Jimmy Lebenthal think about both?
Well, there's a lot to unpack in what you just said. And I'll start by using a phrase I've used for the last couple of weeks, which is that there are a lot of parabolas out there. And by that, I mean stocks that are just going parabolically higher. Some of them deserve it. I've already justified Cisco Systems. Some of them seem a little bit like they're punching above their weight class. So Qualcomm, just as an example, is a stock that I own. And I've benefited from the parabola, but I've been actively trimming it because, frankly, their last quarterly report wasn't that good. Their guidance wasn't that good. But there's a lot of hype in their participating in data center buildouts and other up-and-coming technologies. And I don't really like investing in hype. But when we put this all together, I think this is the classic stock picker's market. Now, I want to talk just a second about the parabolas because that's what we're selecting here is what parabola do you want to participate in? Bear in mind that parabolas very seldomly, if ever, stop at the top and trickle along from there. Usually what happens is you give back a little bit of the parabolic ascent and then you consolidate for a while. And if there's a real fundamental reason for the original surge, then the stock will start rising again. But we do have to consider whether there is a corrective or consolidation phase yet to come in many of these stocks. I've made the case, Amber, that you can still invest in Cisco here, that we're not in danger of having reached the top of the parabola. I've just made the case that with Qualcomm, I think we got a little giddy there. Many of these parabolas may face a day of reckoning in the coming couple of weeks with SpaceX, because there's going to be something like $100 billion odd dollars of capital, fresh capital, that's needed to invest in SpaceX. That capital's got to come from somewhere. Yes, there is a lot of money market funds out there, but it's more likely that investors will sell some stock to keep their allocation constant overall. They'll sell some stock somewhere to invest in SpaceX. And what are the most likely candidates? I think it's the parabolas, if you ask me. I think that's where the money is most likely to come from.
Would you buy SpaceX?
Allow me to give the disclaimer. I have to give the disclaimer. I'm sorry. As a firm, Cerity Partners is not participating and not making a recommendation buy, sell, or hold in SpaceX. Okay, with the disclaimer out of the way, I'm going to answer your question. Let me give an aside here because I think it's amusing. Back in the Navy, I was a submarine officer, and we had a set answer when somebody asked us if we had nuclear weapons aboard our submarine. The answer was, I can neither confirm nor deny the existence of nuclear weapons on board this ship. However, it is Navy policy not to have tactical nuclear weapons on board submarines. Okay, to me, that's amusing. I'm sorry if it bothers anyone, but in this context, SpaceX is trading, it appears, at the valuation that it's going to come. It's going to be 90 times sales. Doesn't have GAAP earnings, but it does have positive EBITDA. I'll give you that. It does have positive EBITDA. On an enterprise value to EBITDA basis, it's something like 300 times. So for a fundamental GARPy kind of guy, I can't really get behind that valuation. To be fair, and one has to be fair, I could say the same thing about Tesla, and the stock has, done fabulously for many years. Why is that? It's because of Elon. It's because of him. There is a sentiment behind him. There is a very large contingent of investors who will invest with Elon, whatever the valuation is. I think it will be interesting to see if there's enough of them to counteract those fundamental valuation-oriented investors like myself who probably don't want to invest in it.
All right. Now I understand the submarine story. That all made sense. Okay, that great perspective. Let's get into the mailbag because we've got a couple of questions on some stock specifics. The mailbag is brought to you by Hamilton ETFs. The traditional 60-40 portfolio, 60% stocks and 40% bonds, has been a cornerstone of investing for decades. But it relies on one key idea, that stocks and bonds offset each other. And in today's market, that hasn't always held up. And it isn't always about performance. It's about managing volatility. That's where the Hamilton Enhanced Mixed Asset Allocation ETF, ticker MIX, comes in. MIX. Think of it as an evolution of 60-40. It combines 60% equities, 20% bonds, and 20% gold. Gold acts as a third layer of diversification, which has historically been a safe haven during market stress, an inflation hedge, and less correlated to bonds and stocks. So instead of relying on two asset classes, you now have three. When you backtest the mixed asset index back to 2004, you get similar returns to the S&P 500. And when you add leverage, modest leverage, 25%, the index has historically outperformed. And importantly, the index's volatility has been lower with this 60-20-20 approach, even after modest leverage. And the index's drawdowns during market sell-offs has been less. An example is during the financial crisis. The S&P 500 fell 55% peak to trough. The mixed asset index only fell 27%. And even with leverage, it only fell 33%. So you get historically shallower declines, smoother returns, and typically faster recoveries. And that can matter because investing is not just about returns. It's about whether you can stay invested long enough to achieve them. Mix is designed to seek long-term growth with a more balanced and more manageable investing experience. A modern mix of stocks, bonds, and gold built for today's market. For more information, visit hamiltonetfs.com or visit the link in the show notes. Okay, our first question in the mailbag is Lululemon. I think they report this week. My goodness. I like to get tempted by these broken stories and I like to think, but I'm glad I didn't touch Lulu because it's been a heartbreaker. Now they've got a new CEO the market is not sold on. They had activists. They're at a standstill now with their founder, Chip Wilson, who's also angry at them. Do you touch this one?
I like this question a lot. So this is a broken growth story. We remember several years ago, this was a stock you had to own. Not that there ever really is a stock you have to own, but that's what people said.
Yeah.
And it has fallen on hard times. And the reason I really like this question is because remember, we were just talking about Cisco and when did I get into it? When it had broken, when it had become a broken growth story. So I like the idea, but I'm not going to do it with Lululemon.
Why?
And because there is just too much darn competition. And there's competition from some wounded entities like Nike, right? Which is when you compete with wounded entities, you sometimes get into a price war, which is not good. You also have the growth area in this area, athleisure. The growth area is coming from China, and China has many homegrown companies that it is promoting above Lululemon or Nike or anything like that. So I think there is a pretty good chance that Lululemon becomes a value trap. Under Armour is a great example of that in the same space. So as much as I like buying a broken growth story, this one isn't for me.
Okay, we've got a question on energy stocks in general. I can't believe how long have we been talking? And I haven't even asked you about the Strait of Hormuz and all of that, even though, the market has basically decided that, this thing is going to be done and over with and eventually will open and we'll all go back to normal. Do you agree with that premise? And what are you doing with energy stocks?
Well, the market does seem to be indicating slightly that a resolution should be coming. I say slightly because if we look at West Texas Intermediate, before I started talking to you this morning, it was around $90 a barrel, and that's down from 102, 103 a couple of weeks ago, but it's still well above the prices from a year ago.
And actually, sorry, I'll give you the most up to date. Now it's 94 because it does look like there's an impasse. Surprise.
Okay.
Surprise, surprise. The U.S.
Exactly.
and Iran, are at some sort of impasse. So we've seen this before, and crude jumps back up. What do you do with that as an investor?
I have been bullish on energy stocks. We have been bullish since well before war broke out. And we think that you can continue to own energy stocks. Now, you have to understand that if the Strait of Hormuz opens, it's not going back to normal as it was a year ago. For one thing, strategic reserves around the world are very, very low. So in addition to normal demand from just operating the global economy, we're going to be refilling those tanks around the world that were part of the strategic reserves. Then additionally, a lot of production that has been shut in the Persian Gulf area is going to have to be restarted. And that transportation supply chain is going to have to get going, which is going to take several months. Amber, we spoke not that long ago about Cisco and the supply chain bullwhip effect post-pandemic. You're going to see that with energy as well. So going back to normal may have energy prices a little lower than they are now, but not by much. That's the bad news.
What's the good news?
The good news is if you're patient, which in my book, How to Ride the Subways, I really preach patience.
Yes.
Sometimes you have to take the local train instead of the express. If you think out 3 years from now, I know that's a long time, the world is going to have decoupled from the Persian Gulf. The world clearly knows now that it needs geographical diversity in its energy sources, and it can get that. It can get that from things like liquefied natural gas coming from the United States. It can get that from drilling in areas of the world that were previously off limits, deep water areas that 10 years ago would have been very hard to access. Shale technology, hydraulic fracturing, lateral drilling, that can be exported around the world. So the world is very likely to reduce its exposure to the Persian Gulf going through time. And that will help place a ceiling, if you will, on energy prices. But we're talking 3 years from now.
You're an American investor. There's a lot of choice in the U.S., but I'm curious, obviously, we're Canadian. We've got lots of energy stocks. There's a big question about Canada and whether we can actually become this energy superpower, which is interesting because we obviously have the resources, but we haven't been able to, get out of our own way over the last 10 years. As an American investor, how often do you ever look north of the border to get some of this exposure?
I'm not right now, and the issue is, I'm sorry to say, because of the tariffs and just the uncertainty of what's going on there. But I can absolutely agree with the premise you started with, which is that Canada is an energy powerhouse, unquestionably. And if you look at the Energy Information Agency and its projections for LNG export buildout over the next 5 years, about 20% of that is projected to come from Canada. So that decoupling from Qatar, just as an example in the Persian Gulf, will absolutely benefit Canada and the U.S. as both countries build out their export facilities for LNG. I'd love to get the U.S.-Mexico-Canada Act reinstituted or reinvigorated, whatever the right word is. I don't agree with the policy of tariffs on our neighbors. We should continue with the previous policy, which was building a North American powerhouse between the three countries, where trade flows seamlessly in and out and amongst those three countries and builds a competitive force against the rest of the world. That's my own personal belief.
So that's interesting, though. As an investor, the tariff overhang is enough for you to say, well, I can be patient. I'll wait to see how this shakes out before you invest here.
Yes. Yes. There are resources. We know, tar sands have been for now several decades a major resource. And even though I just lambasted tariffs, let's not forget that prior administrations really curtailed pipeline exposure between the two countries that was very important to getting those tar sands oil flowing from Canada to the United States. So listen, it's a problem that America has with its political structure, where we're running, it seems like, on a 2-year election cycle. And that makes it very difficult to get energy policy, which really needs to be in place for decades, to be sustainably implemented.
Well, and to how political that is, even the word tar sands, that makes a lot of Canadians who are like, no, it's the Canadian oil sands. So I can already feel like I'm going to get a lot of emails about that.
Well, you can blame me. You can blame me as being an old man who remembers it by the prior name.
Well, one thing Canadians have been doing is limiting their travel in general to the U.S., though that, I don't know how big of a factor that is for Disney, which has the parks business. Disney is sort of our next question. This seems like a classic Jimmy Lebenthal stock, a broken growth story. Do you like it?
I do like it. I'm a little bit perplexed at how cheap it has become, trading roughly 15 times forward earnings. And it has a lot to do with what you've just said and what we've been talking about, which is not just tourism being curtailed by presidential policies. It's also inflation, which has cut into the amount of disposable income that people can spend on things like Disney theme parks. But we do think that eventually, I hope it's not 3 years, but eventually the energy situation is going to be worked out and inflation will be coming down. We know that Disney has invested and continues to invest mightily in its experiences, which is not just theme parks, but the cruise ships, for which demand seems to be insatiable. Combine the experiences business with the streaming business, Disney Plus, which continues to grow nicely with healthy margins, and a broadcast studio business that has been, I don't want to say flat on its back, but it hasn't been growing well. I see opportunities for growth to pick up again in Disney. And at 15 times forward earnings, I think it's probably a pretty good buy here. I'll also point out they have a pretty good track record of increasing their dividend. So if you have to wait, if you have to take the local train in the subway and be patient, you're getting paid while you do so.
I love that analogy. We've got a question on the banks. Our fans know that you're a fan of Citigroup Bank. And the question is actually, Citi has done well. What about a rotation out of Citi into JP Morgan, which has struggled in 2026?
Well, I own both. I did trim Citigroup recently. It simply grew to be too big a part of the portfolio, but it's still it's about 5% of the portfolio, which again, any professional money manager is probably thinking they need to stage an intervention with me for having that big of a weight in Citigroup. I still believe in it. And I'll start with Citigroup before I get to JP Morgan. Yeah. Citigroup has gone from ridiculously cheap to kind of cheap. Okay, so it used to be trading 2-3 years ago at about 60% of book value, which was insane. And they were buying back shares. I know it's like the 5th or 6th time I've talked about share buybacks, but Amber, consider when they were buying back shares, they were buying $1 worth of value for 60 cents. I mean, that's gold.
Yeah.
Now they're trading at about 120% of book value, so it's not as cheap. However, it's about 10 times earnings. I'm not going to look up the dividend yield right now. I want to say it's about 2.5%. Here's the thing. There are still some catalysts to come. The pending spin-out of Banamex, the Mexican retail operations via IPO, should happen in the next 6 to 12 months. That will free up some capital. It will make their leverage ratios better. They'll probably do some more share buybacks. We also have an economy that I mentioned before is still doing quite well here in the U.S., and so that should make credit metrics very good for the companies and individuals to which Citigroup lends. And their profitability metrics overall continue to go higher. So I like Citigroup. JP Morgan, I also like. And my thesis on JP Morgan is very simple. Any sector that you're going to invest in, healthcare, financials, energy, those are 3 that we've spoken about. You have to start with the best company in each sector. And JP Morgan is the best company in that sector. Here in New York City, we look at the skyline, which has been irretrievably changed by the new headquarters that sits on the skyline as if Jamie Dimon is telling the rest of the world, I own New York City. And maybe to a certain extent he does. And maybe go ahead.
Oh, I was going to say, yeah, to a certain extent he does.
It is the 800-pound gorilla in the space. Now, it trades at a premium relative to everyone else, whether you're looking at an earnings multiple or book value. So for that reason, I don't have it in as big a weighting as Citigroup. But Citigroup and JP Morgan are going to benefit from the improving economy, from better credit metrics, from the improving IPO market that they're all going to benefit from trading environments that go along with the IPO market. So there's a lot of positive things for the finance sector at large, and I do think you should start with JP Morgan.
Okay, a final question in the mailbag before we get to your pro picks. Dell went parabolic last week, but still looks like it's very cheap on a multiple basis. And the question is, can you add at these levels? And I think Dell just shook its final bear. There was one who was obviously wrong on the stock, Morgan Stanley, and now he's up to a hold. Which, it was just an epically bad call. He was worried about, that it was just a pull forward in demand and that the back half would be weak. Obviously, we're not seeing signs of that because its forecast was incredible last week.
Well, add Dell to Cisco and Intel amongst those companies from the late 1990s that have found a new mojo, and they really have. Now, all three of those companies are really seeing the same driving force, which is the build-out of artificial intelligence infrastructure. So I question whether one has to own all three of them. I question it rhetorically, but I'm going to answer it literally by saying I don't. I own Cisco. I own NVIDIA. I don't own all of the names in the space. I do think there's more room to run on the artificial intelligence data center build-out, which will benefit Dell, unquestionably. I look at it as a little bit more expensive relative to Cisco, but you can choose your own poison. I'm not damning Dell. I just happen to like Cisco better.
Okay, well, that brings us nicely into our pro picks. Pro Picks is brought to you by ATB Financial. With over $100 billion in assets, ATB Financial is powering possibilities for more than 843,000 financial services clients. ATB Cormark Capital Markets is a leading North American investment firm providing holistic corporate and capital markets advice and full-service financial solutions. Visit atb.com/inthemoney for more information. Surprise, surprise, your first one is Pro Picks. I might have to title this episode a love letter to Cisco because that's how much we've talked about it. But it shows, you really get into the weeds of this business. You've talked a lot about it. I won't make you repeat it here, but do you do price targets? Like when you look at something like Cisco and how much it's run up, it's sitting at record highs. Like, do you math out where you think it could go?
I do, but it's not always the same methodology here. So we were talking, and when we started on Cisco, I think you pointed out the earnings multiple. What I'm trying to determine right now is what is the right earnings multiple, and that depends critically on what the right earnings estimate is here. Cisco, as I've said, it's been a darling in the portfolio. If you consider it, it was really a value stock when I bought it. Mm-hmm. It has now become more GARPy, more momentum-y, which is a beautiful thing if I can continue to hold it. But the question is, when is too long? I think that the multiple mid-20s on a forward basis is reasonable for the growth rate that they're seeing in artificial intelligence, which has gone, as I said, from 1 billion a couple of years ago in AI orders to 9 billion and looks like it will increase. But when I think about that multiple, what also gives me comfort is the cushion, if you will, from the baseline business, the foundational business, which is appealing to enterprises, big companies with that triple threat I mentioned of hardware, software, and security. So it's not all dependent on artificial intelligence. And that combination of the real growth in AI, but the stable foundation in the enterprise business makes me think that the mid-20s multiple is probably the right multiple, especially if estimates are likely to go higher, as I think they will.
One thing I wonder, these order books are exploding, but sometimes you get people a little bit nervous about that is coming from a concentrated set of customers, so that if they get into trouble, then it's all over, right? And I know those complaints were a lot louder for Oracle, and it also had higher debt. But how do you think about concentration risk, and is it as big of a factor for Cisco?
It is a risk for all of these companies, particularly when you look at the top 5 hyperscalers, which includes Oracle, by the way, and their spending plans that have gone from $400 billion last year to $700 billion this year, and it looks like $850 next year. Those growth rates can't continue forever. However, I do think a lot about the private credit underwriters, which I mentioned only briefly a little while ago. When you talk to those underwriters, they're really underwriting these data centers for lifetimes of 15 to 20 years. And what that means is that the chips and a lot of the architecture that is in them are going to have to be replaced. So while we've had this multi-trillion-dollar build-out, which is not likely to continue at the growth rates, there will be a sustainable business in the replacement capital expenditure that has to go on. And by the way, we're not really talking about the fact that the use cases are still up and coming. I think we've only scratched the surface in terms of the use cases. I know this as a consumer of AI. When I think about what I've done with Claude, it's incredible, but I know I'm only scratching the surface. So I think there's more legs to come. Even past this initial build out, there will be replacement CapEx that should keep things going.
Okay, so you like it here at these elevated levels. Your second one is Cheniere Energy, LNG. No surprise, based on the ticker, it's a big exporter of LNG out of the U.S., and it has struggled, down about 24% since the war began. Let's go through some of the issues. I think those are important to understand before we go to what you see as the catalyst.
Well, I think the issue here is that the market is trading Cheniere on the probability that there will be a resolution in the Strait of Hormuz and that natural gas prices around the world will come down. That may be the case, but as I said earlier, I think the world is definitely going to be decoupling from the Persian Gulf in terms of its energy supplies. And if we look at liquefied natural gas, exports here in the U.S. have gone from 50 billion cubic feet in a year 10 years ago to 500 billion. So it's gone up by tenfold in 10 years. And there's still projected another 30% increase on top of that over the coming 5 years, just in the U.S., where Cheniere is the biggest player. But there is this perception, as I said, that maybe natural gas prices have peaked. And that has created this feeling that maybe things were too euphoric a couple of months ago in Cheniere. To me, based on what I just said, I think that 30% pullback is the opportunity to be in a company that's going to be growing in a growth industry for many years to come. And it's worth considering the many years that it takes to build an export facility for liquefied natural gas. Cheniere is not only the biggest player, but well along in its expansion plans.
Okay, so a kind of patient investor stock, perhaps an opportunity to pull back, to buy on a pullback. Your final one, here we are, finally. We got it. I can't even remember the last time someone gave me a Pharma Pro pick. So that's how excited I am. It is ABBV, which is a giant. So not speculative at all. Trades at kind of a favorite number of yours, I'm gathering, 15 times. Forward earnings. What is so special about ABBV, and what do you see as a catalyst?
It's been a great company. Now, along with healthcare, it has kind of not fallen, but it's underperformed the market overall for the past year and a half. And therein, to me, lies the opportunity. This is a company with an excellent management. They had a big task on their plate a few years ago. They had this blockbuster drug, Humira, in immunology type of applications like psoriasis, like eczema, things like arthritis, things like that. And it was coming off patent. So they were going to lose all that revenue. But they've replaced it with new products such as Skyrizi and Rinvoq. And they have also made some key acquisitions to build out a neuroscience program to augment what they're doing in immunology. Well-run company, well-run balance sheet, good dividend yield, 3% as you mentioned, 15 times earnings. And in a sector that has been unloved, to which money might flow as the bubblicious or parabolas, whatever I want to call it, in artificial and intelligence and technology run their course.
You mentioned that, the sector is out of love. Does ABBV need the sector to come back into favor, or do you think they have enough self-help catalysts? Like, do you see them going out and doing deals, or is that era over? And is it just about an execution story?
They're still going to do deals because there's so many small biotech companies, one product companies. The business model in pharmaceuticals is to buy these companies even as early as phase 1 trials. So they're still going to do that. I do think the sector needs to come back. AbbVie may outperform its brethren in the space, but I think if you're really going to get the bang for the buck, healthcare needs to come back. And as I've said, it's been unloved long enough that I think money will start flowing there.
Jamie, it has been an absolute pleasure. Thank you so much for joining me. I really appreciate it.
It has been my pleasure, Amber. Thank you for allowing me to expound, which is what I wanted to do and I did in my book, but you covered many of the topics in my book, so thank you.
Well, people should still get it, how to ride the subway, getting around on Wall Street and in life. And yeah, for all those times that you were on CNBC and you could only talk for 30 seconds, I feel like this was a bit of an outlet for you. We let you talk and we certainly were enriched for it. Thank you so much for joining us.
Thank you so much.
Don't miss our next episode. We've got Alex Letko of Letko Brosseau. He's talking emerging markets and Canadian equities. Those two are different things. You can email us questions at inthemoneypod.com or find us anywhere on social media at inthemoneypod.